next important scheme is about debt funds. So in this scheme, the asset management company is going to invest on the debentures, fixed income bearing securities, and other money market instruments they are investing in the market. And the debt funds are the mutual fund schemes that invest a major portion of the pooled corpus of money into debt or fixed income securities or fixed income instruments. For example, such instruments are like the corporate bonds, debentures, government securities, and money market instruments like treasury bills, commercial papers, certificate of deposits, and repos, where they are investing under the scheme called debt fund or debt fund schemes. Specifically, if those schemes are going to invest, the portion of funds, majority of the portion of funds are investing into debt can be classified as a debt fund. And about the debt fund, there are few important aspects related to that. The mutual fund scheme can invest into the debt securities, but it cannot be give the loan. So those loan segment is not covered under the debt fund. Is purely the debentures issued by the companies. Debentures issued by the debt instruments issued by the public sector undertaking. Debt instruments are issued by the private sector companies. Those type of instruments along with the money market instruments like treasury bills, certificate of deposit, commercial papers and repos can be taken as a debt instrument. And a scheme cannot invest more than 15% of their net assets in debt instruments issued by a single issuer. Cannot be invested. And if the prior approval of the board of asset management company, the trustees they can, with the limit, they can able to invest up to 20% of their investment into the single issuer who has issued the debt instrument in the market. Those papers are unrated, as similar to the listing of securities. Rating of debentures are unrated debentures. It means a credit rating agency is involving with the process of evaluating the credit worthiness of the company who are issuing the debentures in the market. For those companies, how much are the value of the company in the market, financial position of a company in the market, and earning capacity of a company, repayable capacity of the company, liquidity of a company, everything is being evaluated by the credit rating agency before they offer the rating of their debentures or rating of their issues. So those unrated papers, the investment is restricted to the limit of 10%. And the total exposure of debt instruments for the group issued by the group of companies of a sponsor, it should not exceed 20%. However, it may not exceed 25% with the prior approval of board of trustees who are interested, who are ready to invest. If those the kind of instrument issued by the group of company may be relatively worth, rated instruments they are issuing, highly rated instruments, then it is not an issue for the asset management company under the debt scheme. They can invest up to 25% for such debt instruments in the market for the group of companies of a sponsor. And the investment in unrated papers on the below investment grade, or it may be the low investment grade owned by the rated papers, can overall cap of 25% of net assets of such schemes can invest. And the liquid funds can only invest in the money market securities. Major portion of funds are only invest in money market. Rest of the portion they can kept in the form of cash. Up to 91 day, the treasury bills or the kind of the certificate of deposit or the promissory notes they can able to invest in the market. The closely ended debt instruments can invest only in the securities which mature on or before the date of maturity of the scheme. Like for example, the closed-ended scheme has given a new fund offer and the scheme remains closed for a period of 3 years. Within the period of 3 years, the debt instruments only they are subscribing, they are making investment. If one particular scheme is maturing after 4 years, they are not going to invest, because 1 year they are not able to wait, because they are going to close the scheme with the period of 3 years, so that is the information is given. It is also as similar to the equity. These are the regulations are imposed under Securities Exchange Board of India in their Mutual Fund Regulations Act 1996. And not more than 15% of net assets of such a scheme can be placed in short-term deposits which are having a maximum maturity of 91 days. With the permission of trustees, they can go for up to 20% of investment into such schemes. The short-term deposit with the associate and the sponsors of scheduled commercial banks together cannot exceed. Either it may be the sponsor company or maybe a scheduled commercial banks, they can able to invest 20%. With a single company, they can invest 20%. With a short term deposit can be placed in the mutual fund. They can invest on this. Either it may be a sponsor company or going to invest deposits of the commercial banks can go for short-term investment, short-term deposit. Those deposit cannot exceed 20% of their total net assets. And not more than 10% of the net asset are placed in the short-term deposits of any one of the scheduled commercial banks, including their subsidiaries. Not allowed for this. And there are factors which influencing to invest into debt funds, classified as the domestic and global economic environment, prevailing environment in the market, the flow of money supply in the market over the country, and it is about the inflation, prevailing inflation, retail inflation, agricultural inflation, consumer price or wholesale price changes. Those factors are also affecting to determine the rate of return given by the debt instruments. The direction of an interest rate based on the credit policy, based on the statutory reserves of a government, the liquidity position of a particular instrument is highly liquid. It's like money market, which bearing low interest rate, which gives you the lower rate of return compared to the instrument which has which you are going for a longer period of time, which bears the higher rate of interest or higher yield from that, and the yield expectation over the period of time, when the rate of return associated with the debt instrument are the factors for determining investing in debt schemes. So there are few debt schemes are given here. It is like the first one is a gilt scheme, where the investment of 80 to 85% of the corpus is invested. The funds from the particular scheme is invested into government bonds, and remaining fund is kept in the form of cash, or it is going to invest into the money market securities. For example of such schemes like the Tata Gilt Security Fund, Gilt Scheme Fund, they are investing. UTI government securities, they are investing in such manner. The corpus of 80 to 85% is invested into government bonds, and remaining 10 to, it means 20 to 15% is invested into money market or in the form of cash, kept in the form of cash. Mixed debt schemes, it is 30 to 40% of the corpus is invested into government bonds. The 40 to 55% of the funds are invested into corporate bonds and remaining in the form of cash. For example, HDFC Income Scheme, Unit Trust of India is offering bond schemes, are such example for the mixed debt scheme. Different types of debt schemes are mixed together to formulating this scheme. The next one is floating rate debt schemes. Those floating rate debt schemes or like the investment in floating rate bonds. ICICI Prudential floating rate schemes are the best example for this. So normally what the fixed interest bearing securities, apart from the fixed interest bearing securities, the investment is proposed by the company. Even in money market instruments like the treasury bills, they are going to invest, since it is going to give the implicit rate of return that are tend to change according to the market condition. Infrastructure debt fund scheme, 90% of such a scheme of asset is invested into debt instruments of infrastructure companies. Those debt instruments issued by the infrastructure companies. For example, Birla Sun Life Asset Management Company has issued a scheme called Birla Infrastructure Fund. The liquid schemes, it is going to invest into the money market. Majority of the funds are invested into money market. We can say the particular scheme as liquid schemes. Those liquid schemes investing in money market instruments, they are investing in commercial paper, certificate of deposit, repos, treasury bills, they are making investment into the market. For example, HDFC Asset Management Company has HDFC Liquid Fund. Reliance Asset Management Company has a fund called Reliance Liquid Fund. LIC, Life Insurance Corporation, has the liquid fund scheme, which are prominent in the market compared to other schemes. Fixed maturity plans, it's similar to the fixed deposit. There is a fixed term in which the schemes are floated by the asset management company under the debt scheme. All receivables or all securities under this particular scheme is equal maturity period. It is like a closed-ended debt scheme. Investing in government securities or money market instruments or banks fixed deposits also investing. SBI, which it means asset management company, has FMP, fixed maturity plan, series 14 for 100 and it means 1102 days in which the scheme has launched. It is closed after 1102 days. Up to that, the instrument are giving priority for investment. And the capital protection fund, 80 to 90% of the corpus, it is highly rated fixed income bearing securities it has invested, which protect the capital fund, whatever the amount of investment done by the investors in the market. So those schemes are called it as a capital protection funds. For example of SBI capital protection fund, protection oriented funds are the example for this. Thank you.